Welcome to Dollars and Cents, where we help you make sense out of all life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of different radio stations throughout Central Florida. We're also one of the top 25 financial podcasts on the World Wide Web with well over 20,000 downloads. Ooh, go us. Be sure to subscribe to our channel on your favorite social media platform. If you're having any trouble finding us, just go to our website, www.nelsonfinancialplanning.com. Look in the upper right-hand corner, click on the icon that looks most familiar to you, and you'll get instantly connected with our channel. My name is Garrett Fields. I'm a certified financial fiduciary with Nelson Financial Planning. I'm joined with my co-host, Rob Field. He's also a certified financial fiduciary, and he's a National Social Security Advisor with Nelson Financial Planning. Where our team of certified financial fiduciaries stands ready to help you change your life this week with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind over time. So, I know you probably have two questions this morning. The first one being, why are these two very handsome gentlemen on the radio instead of TV? And also, where is Joel Garris? Well, I can't really help you with the first question, but the second one, I can tell you that Joel is fine. We all survived the hurricane, but with the hurricane coming in, he's had quite a bit on his plate, so we thought that we would help out, step in, and take over this. He does love doing the radio show, but the reality is it is quite a bit of work, so we decided to help him out with that. But we have an awesome show plan for you today. We're going to go over inflation. We're going to talk about what it is. And then we're going to go over some pros and cons of inflation. And some of you are going to be shocked to find that there are a couple of pros when it comes to inflation. Then we're going to talk about some things that you should maybe take care of before you retire, and follow it up with a little information on FRS. We were going to have a educational breakfast this week, but unfortunately the hurricane, we had to postpone it. So that's the radio show for this week. And but before we get into it, we just finished the quarter. And so, Rob, I know you did a little bit of research on some numbers for the quarter. So why don't you give us that?
I'd be glad to do so. Good to see you. I know last couple of days we've kind of been in and out of the office trying to get caught up. Hurricane's been crazy. You've been busy as heck helping out yourself and neighbors chopping down some branches, clearing the roads. We still got a lot of road issues, but we are here. Happy to share our thoughts with the Central Florida listeners. We thought we would kind of recap the third quarter investment-wise. We are at September and moving into October. Been a volatile third quarter. We have seen the market hit some really great numbers, and then we've seen some drops. I'll just let you know for this week, the S&P is down another 2%. It's been reactionary to inflation and what's going on with interest rates, and the market's really kind of in a holding pattern, hovering in that area. We did at one point in mid-August. The market was up about 13% for the quarter. We thought we were having a little bit of a rally. Right after that, there was another interest rate increase, kind of brought the market back down. Some of the news shows that there's still skepticism in the market, and so investors kind of did a pullback. Third quarter overall, last 3 months, we're down about 4% total. So you can see what's done in the last week, what's happened in the last 3 months. It's about the same, hovering in that range. We've year-to-date puts us now down about 20% for the averages in the stock market. Tough year, but we're moving through it. Again, we're going to share some ideas of what you could be doing at this time in the market as we move on through the show.
Yeah, but we had the middle of the quarter, we had a pretty big rally, didn't we? What were we up the middle of the quarter from?
Well, going to the middle of August, we actually were S&P hit 42.97, which would be or equate to a 13% increase for the quarter, which got us all very excited, made investors a little more comfortable with going back into the market. But like I said, with interest rates increasing, some of the other economic factors that came out, the market came back down.
So a little bit of a flat quarter, but definitely volatile. Had a run up, got brought down a little bit, and ended up slightly negative. All right, well, let's get into it. So the first thing that we wanted to talk about on the radio program was inflation. In order to cover that, we need to go over what inflation is. So inflation is the rise in prices, which can be translated as the decline in purchasing power over time. That's Investopedia's definition. But what does that mean? So decline in purchasing power. I'm sure you've all heard either your grandparents or your parents talk about how back in the good old days you could buy a gallon of gas for a nickel and you could get into a movie theater for a quarter. Obviously, today you can't do that. A gallon of gas is about $5, and getting into a movie theater, that's an astronomical amount of money that you're going to have to pay. So things have gotten drastically more expensive. And we understand that's what inflation is, but what does it mean by whenever it says declining in purchasing power? Well, a nickel used to be able to get you a gallon of gas. With one nickel, you used to be able to purchase a gallon of gas. Now that nickel no longer has that ability to purchase that. It's lost its purchasing power. Now you need about 100 of those in order to buy a gallon of gas. So that's what inflation is. You can kind of see at how over time it's really taken hold and made things more expensive. Well, how do we gauge that? How do we know how far inflation has come? What about the CPI index? What is that? Well, the CPI index stands for the Consumer Price Index. The Consumer Price Index is a measure of the average change over time in the prices paid by urban consumers for a market baskets of goods and services. That's the definition by the U.S. Bureau of Labor. So what does that mean? That sounds like a cluster. Well, so everyone buys things differently, and what the CPI index tries to do is they try to take a look at what people purchase and how much they spend their money on each particular sector. So it's made up of a couple different sectors. They could be food, medical care, housing, right? But everyone doesn't spend the same amount on food, medical care, and housing. And those all change differently. So if you've been to the gas pump, gas was around $2. Now it's up to about $5. So that's about doubled. Food's up about 30%, and medical care, that's up as well. But they're all up differently. So how do you judge accurately what inflation's been whenever everything's up a different level? Well, is what the CPI index tries to do is they try to put a weight to each one of these categories. So, for example, housing is about 42% of the CPI. Medical care is about 8.5%, and food is about 14%. So they take the percent increase of each one of these sectors, they give it a weighted average, and they try to give you an average as to how much interest rates have gone up. But just like how each individual sector has gone up a different level of inflation, each individual person doesn't spend the same amount of money on each individual sector. So we wanted to get into what's the difference between the CPI and CPIE. Obviously, CPI stands for Consumer Price Index, and CPIE. Rob, do you wanna tackle this one?
Yeah, Garrett, let me run with that for a minute. So there are different CPIs that people look at depending on where they're trying to see changes. CPI or the CPIW is kind of the standard CPI for workers, and it lists the basket that you're talking about, and it allocates certain percentages towards it, and that represents kind of the economy in general. Like the stock market, where we have a Dow Jones Industrial Average that picks 30 large companies, or we have an S&P 500 that looks at 500 companies, or we have the NASDAQ, which will look at kind of small cap. The CPI does the same thing. It has another index called the CPIE, or CPI for elders, and that's a little bit different. We will talk more about the differences as we head back after this break.
Good afternoon. Good morning. We're back with Dollars and Cents. On the previous segment, we got into inflation. We were talking about what inflation was, what the CPI index is, and how there's a different CPI index depending on who you are and what age you're at. Obviously, what we were talking about earlier was depending on what stage you are in your life, you spend money differently. So as you get older, you might spend more money on medical care versus when you're younger. When you're younger, you might spend more money on housing because when you're older, you might have a mortgage that's paid off. But Rob, you were talking to us about the different CPI indexes. So why don't you take it away?
Correct. We all kind of follow the regular CPI or CPI for W, but there is a CPI or Consumer Price Index for the elder. And it's basically rebalances some of that basket to be more accurate to what an older retired person might be going through. And so, we have clothing, that's about the same, education's the same, recreation's the same. Medical care, in that basket, medical care is really almost twice as expensive per year for an elder as it is for a normal person. So we, we think that's important. Normal CPI doesn't really cover that. Food, actually, the elder is actually eating less. Retirees have a tendency to, not consume as much food as a younger person. Transportation, sometimes transportation is actually lower for the elder, but where it really gets hit is housing. A lot of people, as medical care allows them to live longer, assisted living, having people living with them, having to go into special places for helping them as they do get older, that's a lot more expensive. And it's usually, medical care is about twice as high as the normal CPI on the CPIE, and then housing is about 20 to 25% higher for the elder compared to the CPI. I point that out because when it comes time for Social Security to decide what the cost of living adjustment is going to be, right now they're still looking at the CPI for the worker, which isn't really as accurate pertaining to what an older person who's retired or the elder might actually be experiencing.
Yeah, because they're just spending their money differently. The portion of their income they probably have to spend a little bit more on prescription and drugs and doctor's visits. So that makes sense that's a higher that's a higher percentage. The other thing that we wanted to get into is the numbers. I know over the last couple months they've been throwing out some inflation numbers. Like for example, May inflation was up 8.6, June was up 9.1, July was up 8.5, and August was up 8.3. What does that mean? Does that mean that from May to June, everything got 9.1% more expensive, and then from June to July, everything got another 8.5% expensive? No, that's not what it means. Those numbers are yearly numbers. So in order to understand those, from May to June, things didn't get 9.1% more expensive. From June of 2021 to June of 2022, things got 9.1% more expensive. And then from July of 2021 to July of 2022, things got 8.5% more expensive. So those numbers are looking back, gauging off of a year ago. They're not going off of the previous month. That's important to understand because that can be very scary if you're thinking that, hey, from month to month, things are getting close to 10% more expensive.
Right.
They are looking back over the last year.
One thing to keep in mind when you look at those numbers, the reason that it kind of skewed up and then came back down is if you compare the cost of gas a year ago, we had a huge spike in gas prices going into June. And it reflected in June much higher than it was June a while back. Gas prices came down, and then we see the trend occurring. So like you said, comparing this month to a year ago, June was the month in which gas prices jumped up dramatically.
Exactly. And with gas only being a fraction of the CPI or a portion of the CPI, you can see how those numbers only adjusted kind of, 0.5%. That's still a good amount, but still, it only adjusted by about 0.5%. And then the other thing that we wanted to talk about is what about interest rates compared to inflation? The Fed's starting to rise interest rates. Why is that? What does that have to do with inflation? Well, what inflation is obviously it's a loss of purchasing power. And what the Fed does is the Fed actually controls what interest rates are. So, for example, whenever the Fed increases interest rates, that's going to trickle down to you and businesses. So something that you've probably seen is as interest rates start to go up, things like mortgages, car loans, possibly even student loans, business loans, those have gotten a lot more expensive. It used to be that you could get a mortgage for about 3%. Now you're having to spend almost 7% to get a mortgage. So what does this do and how does this help combat inflation? Well, whenever interest rates are really cheap and really low, you can borrow money really cheaply. You're a business and you want to take on a business loan. As long as the ROI is above 1 or 2%, whatever the interest rate is, you can take on that loan. So now you can take on a ton of different projects. Or if you're an individual person, you can now possibly buy multiple different homes because borrowing money is so cheap. Well, whenever borrowing money is cheap like that and easy to do, a lot of people do it and vastly increases the money supply. Whenever the money supply gets bigger, each individual dollar loses purchasing power, right? Because there's more in the system, supply and demand. Whenever they raise interest rates, those interest rates then trickle down to us, and it becomes more expensive to borrow money. Whenever it becomes more expensive to borrow money, you're probably not going to do it as much, and that's going to shrink the money supply or at least help stable it out. So that's kind of that relationship in between interest rates and inflation, and that's why they've been raising interest rates, and that's how it helps combat inflation in theory. But we wanted to get into what are some of the pros and some of the cons of inflation. We're going to start with the pros, and some of these might surprise you. First pro is newly issued bonds. So you take a look at the yield on the new bonds. They're going to be significantly higher than the old ones. You go back maybe even a year ago, you look at the yield on a bond, what they're sitting in between 1% and 2%, 1% and 3%.
Yield keeping up with inflation.
Yeah, not even keeping up with inflation. And so now, as you start to see the new bonds getting pushed out, those have a higher yield. Those are closer to 4 or 5. So as interest rates start to rise, you're going to see the yields on bonds get higher, and if you hold them till maturity, they're going to have a better return. Now, obviously, as interest rates continue to increase, that is going to hurt bonds. But if you just take a look at the yield from bonds, a couple years ago versus the yield of bonds now, the yield is significantly higher now, and that's because of those interest rates increase. Another pro is if you have fixed rate debt. So if you have a fixed rate car loan, fixed rate mortgage, those are all going to get cheaper as inflation continues to tick up. So let's say that you have a 30-year mortgage, right? Going back to the example of buying a gallon of gas with a nickel, let's say you have a mortgage, and let's say your mortgage is $1,000 or $2,000 a year. Well, that might seem expensive now, but 30 years down the road, as inflation starts to take hold, that $1,000 is going to lose its purchasing power. It's not going to necessarily be as valuable, but you're still going to be paying the same exact dollar amount for the asset. So it's going to get cheaper over time. It's almost like if you were to go to the gas station back 30 years ago and you'd tell them, hey, listen, I want to pay, $1 for a gallon of gas for the next 30 years. And they agreed to it. Right off the bat, that's going to seem kind of silly because that's what everyone's paying. But 30 years later, if you were paying $1 for a gallon of gas now, you would look like a genius. So that's one of the pros. Another pro is Social Security. And Rob, I know you got some numbers and some things to talk about on that.
Definitely. So as we see interest rates going up and obviously inflation going up, Social Security usually will try to trend every year and do a cost of living adjustment. So we're looking at a healthy 8.5% that will be an increase in Social Security. And that's a big number. If we look at some of the other years of what they did, we were up 6 last year, which was a pretty healthy number. Hadn't seen anything quite like that since the 80s. 1980, 1981, cost of living adjustments were almost 11%. So we're going to see a very large cost of living adjustment on Social Security. And what's also going to be kind of nice is Medicare, which is the expense for Part B premiums that will come out to cover the doctor portion if you're on Medicare. The actual cost per month is going to go down. Last year they raised it pretty dramatically in anticipation of a couple of drugs that were coming out. Those drugs turned out to not be as expensive, and so that they're going to adjust it so that the cost of Medicare will actually go down. So you get a cost of living adjustment, you get a decrease in Medicare. It's a pretty pleasant year for Social Security overall. Again, we can reference that CPI chart. We would like to see a higher increase for people on Social Security. We're still behind where we should be in keeping up with true inflation over multiple years. But we'll take what we can get whenever we can get it.
And whenever we come back, if you're not retired or on Social Security, we have a benefit for you as well in dollars and cents. Good morning, and we're back. My name is Garrett Fields. I'm a certified financial fiduciary with Nelson Financial Planning, and I am joined with Rob Field. He is also a certified financial fiduciary with Nelson Financial Planning and a National Social Security advisor. So on the last couple segments, we've talked about what inflation is, and we were going over some of the pros. We talked about how bonds are going to get, the yields on those are going to go up. Fixed rate debt, if you have any fixed rate debt, that's going to increase. Social Security, I believe Social Security's got its biggest pay increase in 40 years. But if you're not on Social Security, we have a benefit for those of you that are working as well, and that's wages. If you're working and you're not currently on Social Security, when inflation goes up, typically wages go up with it. So, if you're sitting at the end of the year and you're talking to your boss about your yearly wage, you should be arguing for at least an 8% or so raise, because that's what inflation was. Things have gotten about 8% more expensive. So you should be able to negotiate that into your pay increase. Now that's going to be a little tough because, that's higher than normal. But if you get anything less than that, technically you're going to be taking home less. You're going to be losing purchasing power overall with your total income. So whenever you go in and negotiate with your boss, make sure you explain that, hey, interest or inflation is up about 8%, so I need at least an 8% raise in order to stay even with where I was the year before. So that's another bonus. Another bonus is housing. Now this is also going to be a pro, but it's also going to be on the con. As inflation rises and interest rates are ticked up with it, we've already seen mortgages are going to get more expensive. So you look about a year ago, mortgages were sitting around 3%. Now they're up to almost 7.5%. So how is that a possible pro for housing? Well, if you haven't bought a house yet, this is going to put downward pressure on houses. So this is going to, if you were looking at buying a house before, let's say it was a $500,000 house and you were going to get a 3%, that was roughly going to be $2,300 a month that you'd have to pay. Now with interest rates or mortgages being up close to 7%, now that's about $3,500 a month. So that's a $1,200 increase, almost actually a little bit more than a 50% increase. So that's going to dramatically push some buyers out of the segment, and they're either going to have to go cheaper or the prices on the houses are going to have to come down. Well, if there's not enough people looking for houses in that price bracket, you might have to lower the price of your house to attract more buyers, to attract a bigger pool. So that's a possible pro. If you're looking at buying a house, this should put downward pressure on housing.
If anything, I've noticed here in Florida, we've seen you can put a price on a house and it's going to sell for thousands and thousands higher than that, and it becomes a bidding war.
Oh, yeah.
You might even have an appraisal gap where they're like, hey, you might want this house at this price, but it just appraised a lot lower. You got to come up with an appraisal gap. So just having rates go up and slowing down that growth, just getting prices to a point where when you ask a price for a house, that's kind of the price you're going to get. It's going to be helpful to many buyers.
Oh, yeah. And as we've kind of already seen, as interest rates have gone up, and mortgages have gone up, you have seen a slowing of that. It's not as competitive. It's not going for as much over asking. There's not as much of a bidding war. But, yeah, that's definitely still going on, and this should hopefully tick that down. And finally, the last pro, it's going to be your money markets and your savings accounts. As interest rates start to tick up, you should be seeing a little bit more interest that you're gaining in your savings accounts, your money markets, because it's really been close to zero for the last couple of years. As interest rates have been, close to zero, so have savings rates. But as that starts to tick up, so should your savings. And now we're going to get into the cons. So there are some cons of inflation, and that's what people like to focus on the most because they hurt. The first one is going to be interest rates, right? So as we kind of talked about with housing, as mortgages get more expensive, everything's going to get more expensive. You take a look at, your car loan, you take a look at what mortgages are going to be, you take a look at what business loans are going to be. It's just going to be more expensive to borrow money. It's not going to be as cheap, and they're doing that to help fight inflation. Also, housing, If you're currently already bought a house and these higher interest rates are putting downward pressure on the market, well, then you might lose some equity in your house. If you bought the house for $500,000 at a 3% interest rate, yeah, your payments might be the same because interest rates have gone up and your house has gone down, but overall you are losing equity in your house. So that's a definite con.
Very interesting. We're talking about interest rates and housing. And there are some pros that are going on, some positives based on inflation. And there's also in the exact same arena, buying a bond or trying to buy in a house, there's some negatives because, it's the pressure that is on a bond that has been out in the market for a while. Has a current interest rate, and now that rate or that yield is lower than what the new bonds are paying, got to discount that price in order to make it comparable. Same thing happens on the house. Rates going up. In order to get it to a range where people are comfortable buying, if you got to drop the price of the house, kind of get past that bidding war. So it works on both sides, depending if you're looking at cost or if you're looking at actual interest and yield.
Right. Yeah, no, I love that example of the bonds. I mean, if you had a bond, let's say you bought $1,000 bond that pays 2% a while back, and now let's say bonds are close to 4%. Well, why would anyone buy your bond at 2% whenever they would get a brand new one for 4%? So now is what happens is instead of selling your bond for $1,000, you might have to sell it for $500 to make it even, because interest rates have doubled. So now the price of your bond, or what you can sell it for, has divided in half, right? Because 4% of 1,000 is the same percent as 2% on 500. So that's kind of how that works. As interest rates go up, those bonds go down. And yeah, it's not it's not exactly correlated like the bond market, but it's very similar with the housing market. Yeah,
Correct.
And then another con, I'm sure this is the one that you guys have all seen, things just get more expensive. We kind of talked about it in the first segment about the different sectors, but gas has gotten more expensive, housing has gotten more expensive, medical care has gotten more expensive.
Loaf of bread's got more expensive.
Everything is just getting more and more expensive, and that's just because each individual dollar is losing its purchasing power. And finally, the last one, and this is kind of a tricky one, is taxes, right? So how could taxes possibly be a con with inflation? Well, let's go back to the example. Let's go back to one of the pros, wages or Social Security, and let's say that you're making a little bit more money. Well, what happens whenever you make more money, right? You get taxed more, right? Take a look at the tax bracket. You go from a 12% tax bracket, 22% tax bracket, 24% tax bracket, somewhere in the 30s. So the more and more you make, the more and more you have to pay in taxes. So let's say that you go and you're talking to your boss and you do negotiate a higher wage. Well, that might not your gross pay might come out 8% higher, and you might be even with inflation, but that doesn't mean that your net pay is necessarily even with inflation, because if you were in the 12% tax bracket and now you negotiated a higher wage and all of that wages then gets pushed into the 22% tax bracket, well, that's about 10% less than what you're taking home. So you're not necessarily even, because obviously as you climb the tax bracket you have to pay more. So keep that in mind as you're negotiating your wages. Just because you're making more money and just because you're making the amount that you want to be making doesn't mean that your take home is going to be the same, because as you start to make more, you're going to have to pay more in taxes, and that's just the way it works. But we do have a couple of ways that you can keep up with inflation. I know, Rob, you kind of wanted to kick that off.
Yeah, I wanted to kind of piggyback on what you were just talking about with the tax bracket. Social Security, we said the pro would be, hey, the amount that you get per month is going to go up. But Social Security can be taxable depending on your total adjusted gross income. So the same thing's going to happen to what you're talking about. If you had an increase in your income from wages, bumps you up possibly into a different tax bracket. Same thing with Social Security. So now, again, we're hitting the elders. We're saying we're going to get you more money per month, but part of that's taxable. So part of that portion that's taxable may push you and your new income, which is increased, up to a higher tax bracket. Again, I lean towards trying to help the elderly. I encourage everybody to give me a call, and we can talk a lot about Social Security and how it affects you in general. But those tax brackets, they're not moving up. They're not keeping up with inflation. But everybody's income, the amount of their Social Security, it's going up, and that's creating this tax issue you were just describing.
Absolutely. And when we come back, we're going to talk about a few ways that you can keep up with inflation, also some things that you should do before retirement. This is Dollars and Cents with Nelson Financial Planning. We'll be back with you shortly. Good morning, and we're back with Dollars and Cents. My name is Garrett Fields. I'm a certified financial fiduciary with Nelson Financial Planning, and I am joined with Rob Field. He is also a certified financial fiduciary and a National Social Security advisor with Nelson Financial Planning. On the previous segments, we went over inflation. We went over what it was, what some of the pros were, what some of the cons were. And now we're getting into, well, how do you keep up with inflation? What's the best hedge against inflation? And Rob, I think that you were getting ready to kick that off.
Yeah, I wanted to share a couple things. Obviously, keeping up with inflation requires growth. And so you've got to find the asset class that's really keeping up with inflation, that grows like inflation. We lean towards the equity market or equities inside of mutual funds. The economy, part of the growth of the economy comes from companies that go public, and then as they grow, they're paying dividends and they're building products that we're using. So that's a great way to show the growth of the economy for inflation, and a great way to participate is to own those stocks. History has shown us that over time, really the stock market provides some great average annual returns. Gives you a lot of headaches. It can be a little volatile. We have quarters like we just finished. It's a little nerve-wracking. But when the dust settles, those 5 and 10-year numbers, extremely competitive. And we highly recommend that people can take advantage of that. We're big fans of mutual funds. It gives you the diversification. Instead of having one stock, you got multiple stocks. With mutual funds, you can set up a consistent investment plan. We're big fans of dollar cost averaging. With dollar cost averaging, three things are going to happen. One is you decide to put money in systematically over a period of time. And if the market is consistently going up, you've participated, you're getting that growth, all is great. If you are consistently throwing some money in, maybe on a monthly basis, and the market remains flat for a while, but eventually starts to go up, because we have seen over time the market does have positive average returns. You have loaded up your money, you're in there. When the market starts to make its move, you're prepared. Other thing that happens is you start throwing money systematically into the market, but the market pulls back for a period of time. Maybe what's going on right now in the third quarter. But if we know that on the averages, 5, 6, 7, 8 years, you got some great returns, nothing wrong with getting some of those shares of your mutual fund at a discounted price. And then when the market goes up, your cost basis is even lower. So we feel like the great way to address inflation is to get into an investment plan that does help you grow.
Perfect. And then something else that we kind of wanted to talk about on the radio show today was a couple things to consider before retiring. I know you had an article for us about that.
Yeah, I did some research, and there's kind of this new thought process of slowly moving into retirement. Don't jump in head first. Sort of, a lot of people refer to it as to taking a sabbatical. And what you do is, instead of scheduling a vacation, take 2 weeks and going someplace that's just pure fun and just kind of checking out for a while, is decide, I'm getting close to retirement. I'm going to take a vacation, but I'm going to make it a pretend retirement vacation. I'm going to act like I'm going into retirement, and I'm going to do something, or what I think I would like to do in retirement, whether it was to volunteer, whether it was take an RV trip, go visit the grandkids, travel overseas. So it's kind of like a test run. And the thought process is to think about what you're going to retire to, not necessarily what you're retiring from. Don't get hung up on, okay, I'm not working, that's great, but okay, what am I going to do? Where am I going to go? What do I want to achieve? And what will make me happy? So money's going to come into play. What are your goals? What's it going to cost? If you do a test run and say, okay, I'm going to act like I own this RV, or I act like I'm going to go these places, what does it actually cost? It's going to test your emotional readiness, because a lot of people, and I'm unfortunately in the same boat, work plays a big part. I love my job. I spend a lot of time here, and I truly build my life around what's going on here at work, and it works out great. If I were to leave here and retire, it's a whole new world. I don't know how emotionally I would feel. Other people feel the same way. So before you fully retire, if you practice it, kind of take that test run, you can always say, hey, now that I've pretended like I was retired, I don't like the results. I'm going to have to do something different. And a lot of times it's remaining back at work. Now, a lot of times if it's, hey, I looked at the cost and I actually kind of really got serious about what's it going to cost to retire, and I realized these numbers that I'm currently looking at with my investments aren't quite there, I'm going to work longer. Or I'm okay with my investments. I feel comfortable generating the income I want, but I sure don't like just sitting around. Volunteering is not enough for me. I'm going to go back and I'm going to get maybe a part-time job. So the recommendation, do a trial run first. You can always jump back into the workforce if for some reason or another it didn't work out the way you would like. Once you hit that point and you're comfortable with, financially, I like what I'm doing, I know what I'm going to do, I feel like that's going to be rewarding to me, then you got to go one of two directions. I'm going to continue to work part-time, or I'm going to fully retire. At that point, that's where you and I kind of jump in. We say, okay, we got to do a comparison of what are your goals, what is your budget, and what do we think your portfolio can actually generate income-wise or estimated growth over time. So, Nelson Financial Planning and Retirement, hand in hand, what we're trying to do is match up your goals to what we think your investments can do. Projected income, that's our goal. What do we think we can generate for you? What is your budget? And then is there a gap? Because two or three things can happen when we get to this point. One would be, you got a budget, we have estimated income, your budget's higher than the income, we got to tweak something, either continue to work, change your budget. We would love it if you came in and said, here's my budget, and we said, here's what we think you can generate in income comfortably. Income outweighs budget, that's wonderful. The problem with that is 9 out of 10 times the budget's not high enough. And people say, well, great, this is how much I need per month. But before I start retirement, I'm getting a new truck and I need an RV, or I want a boat, or we're going to take a $10,000 trip to Europe, or I promised my kids once I retired I would give them some money. That takes away from the investments that we are calculating to use to generate the income. So very, very careful about matching those two up. And as you know, Garrett, we're not fans of doing what people call annuitization. Mm-hmm. We're not going to say to you, you've got this lump sum of money. We're going to try to make it last as long as we can. If your estimated life expectancy is 95, we're going to get you to 95. Our goal would be hit 95 and you still have the majority of your investments in place so that you can continue to keep up with inflation, continue to increase your income if you need to, continue to make fun trips, other purchases, trade in the first RV you got when you're retired, get a newer RV later on. We want your investments to still be able to do something like that for you. So upfront expenses just as important as projected income.
Exactly. And you know, it's amazing because we do run into some people where they retire and then they get into retirement and they're bored and they really want to go back to work. And it makes, you know, it's important to plan that out, because if you decide to retire at, let's say, age 62, and then you realize, oh, I'm bored, well, if you start in Social Security, you've put yourself in a little bit of a pinch, because you can only make a certain amount of money. I believe it's like $20,000 a year before you have to start giving your Social Security back. So it's important to get this planned. It's important to get this tested, make sure it's what you want, and make sure you're really, you know, geared up to either go back to work or to stay retired permanently. It's an important process. But we're running out of time today. I know we were going to get into FRS just a little bit, but unfortunately we don't have time for that. If you are in the investment plan or an FRS employee, if you're an FRS employee, we were going to have an educational breakfast for y'all this past Wednesday. However, unfortunately, because of the hurricane, we had to move it. We moved it to this Wednesday. So if you have any questions on your FRS plan, how it works, what all the in and out components are, make sure you give our office a call. We'd be happy to get you plugged in for the breakfast, for the educational breakfast. Just give our office a call.
Nice chatting with you guys today. Central Florida, stay safe. Enjoy the weekend. Hope you stay dry.
Absolutely.